Okay, so today we're going to discuss the idea of the loan to value, what it means, what banks use it for, and more importantly, how to calculate it. So to begin with, the loan to value is simply as follows. It's the value of the mortgage divided by the value of the property, and it's expressed as a decimal, or you can multiply it by 100 to give you a percentage. Typically in lending, what you want to see is that you've got a loan to value, quite often say if 80% or less or 90% or less. And the way this occurs is that a person puts down a deposit for a property. So imagine someone was buying a property for €100,000 and they put down €12,000 and they borrowed €88,000. Their loan to value would be 88%. Then you've got to ask yourself, why does that matter to a bank? Well, a person having equity in a property means that if values fall or if they stop paying their loan and the bank have to foreclose, that their equity is eaten into first. So the bigger that buffer, the safer the loan is for the bank ultimately. And that's why you'll often see things like tiered variable rates. Now, what is a tiered variable rate? Is a standard variable where you get a different price based on this loan to value. So imagine that you were doing two loans to people that you knew, and they were for houses. Let's just take the banks out of this for a moment. And one person says, I'd like to borrow €50,000 on a property worth €100,000, and the other says, I'd like to borrow €99,000 based on a property that is also worth €100,000. Now, all things being equal, you'd be better off to do the loan of $50,000 and perhaps even do that twice with the $100,000 available, rather than do one person at $99,000. Because if anything goes wrong with that one person, everything collapses. If something goes wrong with one of the two people that you gave $50,000 to, you'll still have one performing loan. These are all things that are oversimplified for the sake of doing this video, but they help to explain the relevance of this loan to value concept. Sometimes you'll also hear it referred to as the LVR, which is loan value ratio, depending on the country that you're discussing this in. But they all go back to the same thing. It is, again, the value of the mortgage above the value of the property expressed as a percentage. Thank you.